It's 9 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. A warning for big oil. President Biden says he'll ask Congress to pass a windfall profits tax. Meanwhile, BP joins the energy firms posting near record earnings. An historic move for the Bank of England. It becomes the first major central bank to actively sell off assets bought during a 13-year stimulus program. And Credit Suisse tells bargain hunters not to bother. Chairman Axel Lehmann tells Bloomberg the Swiss bank is not for sale. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta and Kailey Leinz in New York. Matt Miller is off today. And Kailey, a lot to talk about this morning for a day that seemed quieter than the rest, perhaps, given we are ahead of the FOMC, Bank of England jobs report. But some really interesting market-moving rumours only, but the market jumping on them through the China session.
Yeah, unverified social media post is circulating talking about China potentially forming a committee to talk about strategies to exit COVID-0. Again, unverified, I would stress that, and yet it spurred a major rally in brisk assets. Really stocks higher across the board, and it was technology that really led the charge. The Hang Seng Tech Index up nearly 8 percentage points overnight, so a massive move there, while the Chinese benchmark, the CSI 300, was higher by about 3.5%. So obviously a lot of optimism about the potential reopening, or at least an unleashing of some parts of the Chinese economy that has been under this COVID-0 policy for years now, and it gave a lift to the Chinese yuan as well, strengthening against the U.S. dollar by about 0.6%. Offshore yuan dollar trading at 729.27 at the moment. Now, other than that unverified social media post, the other news out of the Asia-Pacific region overnight that's worth mentioning came in Australia. The RBA hiking rates by just 25 basis points. And yes, they signaled more hikes are to come, but still that is such a small size hike compared to the outsized hikes we've gotten used to, and especially the hikes we're expecting from the Federal Reserve and the BOE in the next 2 days. So on the back of that, you saw the 3-year yield in Australia down about 3.5 basis points to just shy of the 326 level. But again, Kriti, 25 basis points, not what we're expecting tomorrow, not what we're expecting on Thursday.
Not at all. In fact, I'm curious about how much that brings to the question of what is and what isn't actually priced into the market today. Perhaps a little bit more optimism when it comes not just to the stock market, but to the bond market as well. Take a look at futures up about 0.7%. The bond market also, like I said, catching a bid. The 10-year yield, though, slightly below that key 4% level, 398 on the 10-year yield. But look, already that volatility really sinking in, down about 6 basis points on that note. But take a look at one of the currency pairs that I'm really watching. It's not the dollar. It's actually the Brazilian real versus the Mexican peso. This is crucial as a kind of emerging markets cross to go to. When you're looking at exposure, you're looking at two countries in the EM space. It's Brazil, it's Mexico, and there tends to be a seesaw, a kind of trade-off between the two. Given the lack of commentary from Bolsonaro against the win from Lula, you are seeing a little bit of weakness in the Brazilian real, but once again, only down by 0.1% against the Mexican peso. So we will see as we get more developments out of the country, whether or not that actually sustains or perhaps worsens. The other part of the equation you have to know is simply the grain story around the world. Commodities really kind of rising here, and that's why I'm looking at the Bloomberg Commodity Index, Anna, up about 0.4%.
Yes, and some of those commodities rising, as you say, around that grain story and what we heard from Russia over the past 48 hours or so, Kriti, and some of those commodities rising because of that narrative that developed through the China session, and it might turn out to be nothing, but it was certainly a rumour that the market decided to buy. So we saw, as Kailey was pointing out to us, we saw strength coming through in Chinese stocks, in Hong Kong tech stocks, and all of that filtering through into higher energy prices, oil prices on the rise, and filtering through into basic resource stocks doing pretty well here in Europe. So the European picture looks pretty positive. The CAC 40, the FTSE 100 all up by more than 1.5%. Let's have a look at some of the components of this and some of the interesting movers of the day. Basic resource stocks, as I mentioned, are getting a boost from that China story, up by more than 3%. BP, on the other hand, it started out actually pretty well, but that early gain fading as they report near record profits, and they announce another big share buyback. That seems to be a couple of the trends that we've seen from other big oil businesses, big energy businesses. Prosus, this is a Dutch listed business that has a big stake in Tencent over in China, and so this is feeding really directly through from that Chinese story, up by 7.9% on the Prosus share price in response to what we've seen overnight in Asia. And Credit Suisse up by 2.1%. This, as the chairman says, that the business is not for sale. Of course, it could still attract interest, Kailey, whether he wants it to be for sale or not, but certainly they don't see any need to put the business up for sale right now.
Yeah, and we're going to have more on that Credit Suisse story in just a couple of minutes. First, though, we want to touch on what we got from the Biden administration yesterday. President Biden saying he will seek to impose impose higher taxes on oil companies that are making windfall profits without reinvesting in production, a promise that will be all but impossible to deliver. His proposal came as gasoline prices are still high a week before midterm elections. He spoke yesterday.
You know, at a time of war, any company receiving historic windfall profits like this has a responsibility to act beyond their narrow self-interest of its executives and shareholders. I think they have a responsibility to act in the interest of their consumers, their community, and their country. To invest in America by increasing production and refining capacity.
Meanwhile, big oil earnings are continuing to roll in, with Saudi Aramco and BP both reporting surging profits. And as Anna mentioned, Creedy, BP announcing another $2.5 billion worth of share buybacks. And this is the catch-22 for these big oil companies. On the one hand, you are raking it in because prices are high. You want to give that back to shareholders. And yet that's facing some very real criticism and potential repercussions on the part of lawmakers, both here in the U.S. and frankly as well, where Anna is in the U.K. and in Europe.
You know, and I think that is a crucial part of the story, which on the other hand, you're still seeing pushback coming from the administration. We just heard from President Biden. I think what's important to point out, Anna, though, and big credit to Javier Blas over at Bloomberg Opinion, talking about this, is that the last time some kind of windfall tax was really imposed, it was back in the 80s when we had a similar inflation story. And even back then, it ended up hitting production numbers more than it actually ended up really recouping some of those profits for the government. So I think that's an interesting trade-off to see. Do we see that repeat?
Yeah, well, we certainly see some of those windfall taxes in place in various European countries already. The UK example does have some carve-outs for those businesses that want to invest in UK energy. So interesting to see how that develops stateside. Back here in the UK, the Bank of England is set today to become the first major central bank to sell off assets accumulated during a 13-year stimulus program. This is active quantitative easing now. The unwind will represent a test case for how quickly markets can shift away from easy money policies. Joining us now for more is Bloomberg Markets editor Valerie Teitel. Valerie, take us through the significance of this move then.
Yes, the Bank of England is hosting its first auction today as it continues to roll off this balance sheet at an active pace. It's going to be nearly $10 billion a quarter. What we know is that there's going to be $6 billion of sales into year end. It's going to comprise over 6 different auctions, all $750 million each. But look, this is a big unknown for the market. This is the first central bank to really take on active sales. And we've even had words from the debt management office chief saying that this will likely increase gilt market volatility. Now, we know that the Bank of England, when they decided to raise rates last month, it was unanimous to begin this balance sheet unwind. And let's hope, you know, maybe we'll hear more from them on Thursday on this balance sheet unwind, whether they're still confident that the $6 billion pace that they've announced to year end will be there.
Valerie, let's go from the Bank of England to the Federal Reserve right here stateside. Chairman Powell made a really interesting comment back in March about his favorite kind of metric he looked at for inversion. I think you have a chart for us. Walk us through it.
Yeah, that's right, Creedy. Here is Jerome Powell's preferred yield curve. It is the 18-month forward 3-month T-bill minus the current 3-month T-bill yield. And as you can see, this curve has really gotten close to hitting inversion. Now, why do we care about these kind of things? Well, we know that Powell and the Fed are likely to give us a hint that they want to step down their size of rate hikes. But what things will they point to justify that the step down is needed? Will they point to things like this, like the preferred curve inverting? Will perhaps they talk about last week's softening wage inflation data in the ECI print on Friday? Or will maybe they talk about the housing market? It's going to be a fine needle for the Fed to thread by signaling a slowdown without pushing the market to jump to conclusions that it means a lower terminal rate. And we know that a hawkish surprise from the Fed could come in the fact that they signal a step down, yet they mention that the terminal rate is a bit higher than they expected at last meeting.
Okay, yeah, it's going to be a really interesting one to watch then, isn't it? The extent to which they risk moving financial conditions in a way they don't want to. Valerie, thanks so much. Bloomberg's Valerie Teitel with the central banking stories that matter this morning. Now, back to corporate news. Credit Suisse chairman Axel Lehmann says the lender is not open to takeover discussions after unveiling the company's long-awaited turnaround plan. He spoke with Bloomberg's Yvonne Mann in an exclusive interview this week.
We are going to, to strive again. So we don't have any takeover discussions, and at that point we truly believe we want to stay independent.
Bloomberg's Charlie Wells joins us on set here in London for analysis. Charlie, very good to see you this morning. So how seriously does the bank need to consider talk of takeover bids? I mean, why are we getting this kind of messaging?
Right, so he is talking to us about it, right? So they shouldn't not take it seriously. But of course, a lot of the reporting that Bloomberg has done on this has pinned a lot of this talk back to unfounded rumors from blogs in Switzerland. So, you know, seriously, but not too seriously. But when you look at the situation, it is precarious, right? This bank is cheap when you look at its share price, but it's also selling things that people want. We know that buyers are lining up to buy its Securitized Products Group. We know that Saudi National has invested 9.9%. So it's a little bit like going into a suit store trying to buy maybe one tie, and then, you know, a buyer starts to think, maybe I should buy the whole suit. But of course, we have the chairman saying, not for sale.
Well, Charlie, you mentioned the share price, and frankly, it is a painful chart to look at. What does Credit Suisse need to do to turn that around and really just this broader narrative?
Ooh, Kailey, that is a really painful share price to look at, you know, down 57% on the day of that turnaround discussion on Thursday. And it really needs to work, but they don't have a lot of room to maneuver here. Now, one move that has attracted some attention has been the share price buying $1 million worth of the bank's shares. So that could potentially instill confidence. But previous executives at the bank have made similar moves, so there's no guarantee that that will work. It really is about this turnaround plan. There were questions about whether it was enough, and it certainly needs to be.
All right, Bloomberg's Charlie Wells, thank you so much. Now, we talked about how it's painful when you look at the Credit Suisse chart. It is less painful looking at some other charts in pre-market trading, at least on an intraday basis here in the U.S. We already were discussing the rally we saw in Asia overnight, the big moves to the upside for technology stocks, those Chinese technology stocks in particular in the Asian session, and their ADRs listed here in the U.S. are also doing fairly well by extension. The likes of Alibaba, JD.com, Baidu, each up in the ballpark of 6 to almost 7%. And of course, that reopening story benefits other companies as well, including casino operators, the likes of Las Vegas Sands and Wynn Resorts, which have major revenue exposure to Macau. The easier movement of people, more people potentially going on holidays to the gambling enclave to pay some bets, may help these companies a lot. So as a result, Las Vegas Sands up about 4.5%, Wynn Resorts also up about 3% before the bell, Anna.
Yeah, really interesting to see. Not a lot of facts behind any of this reporting, is there, around what is or is not going on with the COVID policy in China, but certainly the market's jumping on that story, Kailey. Let us tell you what's coming up in the programme. Diana Amoa joins us, Kirkoswald CIO for Long-Biased Strategies. We'll talk to Diana about expectations for global growth, given what we're hearing around China, also expectations around the Fed, of course. And we'll be live at the ADIPEC Energy Conference. That is taking place in Abu Dhabi, of course. Bob Dudley joins us, former BP CEO and current chair of the Oil and Gas Climate Initiative. Plus, how a form of climate bookkeeping has allowed companies to exaggerate their progress when it comes to taming pollution. Read more of today's Big Take story online or on the Bloomberg terminal, and listen to our new Big Take podcast on iHeartRadio or the Bloomberg Business app. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kailey Leinz in New York and Anna Edwards in London. Matt Miller is off. And check out the chart that he's missing here, because it's equities bouncing back from their lows as you start to see the terminal rate kind of stall at 5%. Now, we know Goldman Sachs over the weekend came out and said, well, you know, we actually also think that the upper bound of the terminal rate will peak around 5% as well. Of course, they are late to that call. The market had already decided that, pricing in that peak was going to come in March of 2023. As you have that narrative come on, the stock market actually bouncing back and saying, well, maybe that the pain is over. But I have to ask our guest here, Simon White, Bloomberg macro strategist, joins us about whether or not this is actually going to stick. Simon, the consensus on Wall Street seems to have been that there's going to be a pivot in terms of what's driving the U.S. stock market. Is it still going to be this macro narrative, the Federal Reserve at the helm, or do you start to see a little bit more attention paid to earnings? What do you think?
Well, I think that both are going to be important. The earnings thing is, we've had a mixed season so far, but, the earnings outlook, I was looking at this yesterday, to misquote Oscar Wilde, to get one bad earnings chart is misfortune, two is worrisome, and many more than that is alarming. And every kind of indicator I see says that earnings are going to continue to get worse. Now, the only thing holding up returns right now in the S&P is revenues, the only thing contributing positively. Margins, PE multiples, and are contributing negatively. So revenues in a sort of slowing economy should continue to slow as well. So it's really hard to see from a fundamental perspective what really is going to keep equities in sort of any sort of positive shape.
And Simon, how does that filter through then? If that's what you're seeing, so margins and PE are telling a kind of negative earnings story, but the revenues have been holding up. How does that filter into stock market reaction? Because to Kriti's point, we've seen one of the big drivers being Fed expectations, of course. And if we start to see some kind of pivot or step down in the Fed policy at a time when the earnings story gets worse, does stocks go up or down from there?
Well, it's tricky, right? So I think we're at peak Fed hawkishness, or very close to, or a peak, by the way. I think there'll be another peak later on, right? But I think we're at current peak inflation. So we're at a peak in Fed hawkishness, a peak in global central bank hawkishness. But guess what? Like, if you look back historically, when the Fed stops hiking, so the end of a Fed hiking cycle, the stock market essentially goes nowhere for 6 months before the rally comes. So even if we do hit peak Fed hawkishness, this is not a sign you're going to get this immediate kind of upturn and rally in stocks that people might be expecting.
Simon, obviously the Fed decision is tomorrow. Assuming we get a confirmation of the step down, the market hears what it expects to. Could it be disrupted by the jobs report 2 days later, the midterm elections a week from today, CPI 2 days after that? I mean, are those going to be catalytic events if the market is just assuming still peak hawkishness?
Yeah, I think so. I mean, I think that the inflation narrative is very much tied into the midterms. So I think for me, yes, obviously the jobs numbers will be important if it's a big outlier, but I would say the following week is kind of more important if we, with the midterms, and then we get the CPI number a couple of days later, if the CPI maybe comes in lower than expected, and kind of the political environment perhaps is gradually will begin to change after that. There's not so much pressure on the cost of living crisis. Then I could conceivably see that we really are in a situation where the Fed can feel it can step down from its kind of slightly more alarmist inflation rhetoric, and we move to a more growth focused format.
So maybe we've seen peak hawkishness, and then you point to a period maybe of a plateau, or at least that's what history tells us has happened. Where does that leave tech stocks? Because tech, of course, has been very responsive to that hawkishness from the Fed.
I think tech is going to really struggle. I mean, again, if you look at tech has a very strong relationship with global markets with China. So if you look at, for instance, money growth in China leads tech earnings very strongly. And of course, China right now it's in its own situation. It's still got the COVID lockdowns. It's a capital outflow. So that combination of global headwinds and China headwinds is really going to make it struggle for tech, and therefore if tech can't leak, it's very difficult for the market to make new highs.
Okay, yeah, interesting. A sector geographical link we don't often make, so thank you, Simon, for bringing that to our attention. Bloomberg, Simon White with the latest on the markets this morning, and you can get market analysis. Check out MLIV Go. That's the function to use on the Bloomberg terminal. That's where you find the Markets Live blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Kriti Gupta in New York and Anna Edwards in London. Matt Miller is off today. Now, keeping you up to date with news from around the world, here's the first word. Russia is warning that the security of ships sailing Ukraine's grain export corridor cannot be guaranteed. That comes after Moscow halted its involvement in a grain agreement. Russia has repeated unsubstantiated claims that Ukraine has used the corridor for military purposes. In the UK, Rishi Sunak's government says it's inevitable that all Britons will have to pay more taxes to restore stability to the public finances, especially the richest. Sunak met with Chancellor of the Exchequer Jeremy Hunt on Monday to discuss the budget. According to the readout from the Treasury, they agreed that tough decisions are needed on tax hikes and spending cuts. In Brazil, protests by supporters of President Jair Bolsonaro have intensified. Bolsonaro has remained silent over his loss in Sunday's election, refusing to concede defeat to Luiz Inácio Lula da Silva. Truckers backing Bolsonaro blocked the main highway linking Sao Paulo and Rio de Janeiro. They said they don't agree with the results of the voting. And under new owner Elon Musk, Twitter is limiting content enforcement work just before U.S. congressional elections. The social network has frozen some employee access to internal tools used for content moderation and other policy enforcement. That's curbing the staff's ability to clamp down on misinformation, and it raises a question, Kriti, of regulatory scrutiny over platforms like Twitter, because we have seen a lot of noise made on Capitol Hill about content moderation, about the spread of misinformation online, and so close to an election, that seems very, very testy.
You know, it feels almost like a case of deja vu to some extent, Anna, especially when we saw this kind of play out in 2020 with Facebook. I'd argue with Twitter, with Instagram, with WhatsApp as well. But I remember Mark Zuckerberg really coming under the wire for how much they were doing in terms of content moderation.
Yeah, and ahead of the midterms, as Kailey points out, that certainly is going to be something that is watched very closely as Elon Musk takes over Twitter. Also, what is watched is the business model, of course, and whether he does start to charge for those blue ticks, whether $20 is the right price. He was tweeting back against, he was tweeting this overnight, essentially, when people were pushing back against the idea of $20. He was tweeting overnight saying, well, I've got to make the business work somehow. How about $8? So it seems as if there's plenty of room to influence that number if anybody feels they want to. Right, coming up live on this program, we will be back at the ADIPEC Energy Conference in Abu Dhabi. Bob Dudley will join us, former BP CEO and current chair of the Oil and Gas Climate Initiative. Really interesting conversation to be had there. We'll also speak later to Diana Amoa with a look at the markets ahead of the Fed. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. A warning for big oil. President Biden says he'll ask Congress to pass a windfall profits tax. Meanwhile, BP joins the energy firms posting near-record earnings. An historic move for the Bank of England. It becomes the first major central bank to actively sell off assets bought during a 13-year stimulus program. And Credit Suisse tells bargain hunters not to bother. Chairman Axel Lehmann tells Bloomberg the Swiss bank is not for sale. I'm Anna Edwards in London with Kailey Leinz and Kriti Gupta in New York. Matt Miller is off today. And plenty of top stories to talk about then, Kriti, when it comes to big thematic pieces. But in terms of what's been driving markets over the past 24 hours, rightly or wrongly, expectations changing around China and COVID policy. And that seems to have put some fire under European stocks, Asian stocks, and perhaps US futures.
Yeah, I would agree with that. And you know what's interesting, though, is that in the 2 days before a Federal Reserve meeting, the market tends to sell off. Now you're actually seeing a bid into the market. I think that's a really crucial difference going around this time when you look at what's actually being priced into the market. That 5% terminal rate market consensus now, also Wall Street consensus, I should say. Take a look at futures, though, up about 0.7%. I would argue Anna's point is 100% correct. What you're hearing from China could actually be the game changer for the U.S. equity market, as could be the game changer for the bond market as well. 397 on the 10-year yield. The volatility is what's crucial for me, though, because ahead of the Federal Reserve, you would think that a 75 basis point hike is priced in. You would see some stability there, yet it's only a couple of hours into the U.S. trading session, at least in pre-market. You're already seeing it bid by about 7 basis points lower on the 10-year yield. But that's not the only volatility you're seeing. You're also seeing it in the currency market, not necessarily in the dollar, but you're seeing it in the Brazilian real. I love to look at this currency pair, the Brazilian real versus the Mexican peso, kind of the EM currency pair to go to in the Western Hemisphere. Given the elections we saw over in Brazil, the quietness coming from Bolsonaro specifically, how much exposure do people really want to Brazilian assets right now? And I think that's why you're seeing a little bit of weakness there, down about 0.1% against the Mexican peso. And with that story, the commodity story follows, because it's not just what's happening in South America, it's also what's happening in Ukraine, perhaps, and even in China. A lot of that creating a little bit of a bid into the agricultural market and the oil market as well, both lifting the Bloomberg Commodity Index to a tune of about 0.2%, Kailey.
Yeah, Kriti, I keep thinking about the rally we've seen in so many commodities this year because supply is so tight and demand had rebounded. And that was without China, with China maintaining COVID zero policy. So what happens if China does indeed reopen? That is definitely a question for the commodity market. And it's a question for a lot of companies as well that have exposure to China and the region surrounding it. Like Macau, for example, that is what is the driving force behind the rally in Las Vegas Sands this morning in pre-market trading. It's up about 4.5%, considering Macau is a very important market, and the potential easing of COVID zero policy may make things better in the gambling enclave. And of course, you also saw a big rally overnight in Chinese technology stocks. The ADRs are doing the same in pre-market trading. Alibaba is up nearly 6 percentage points, but it's really more a broader tech story. Of course, the move led by Asia, but the likes of Tesla as well are moving higher. It's up about 1.75%. And then I just added Uber to my board as well this morning, Anna. It's up about 3%. It will be reporting before the bell. Yes, earnings season is still ongoing, so watch out for those results in a couple of hours.
Yeah. Absolutely. We shouldn't forget earnings season, as you say, still ongoing, Kailey. And all this China talk, of course, is just still rumour in the Chinese market. But it was a rumour that the Chinese equity markets decided to buy, and that is filtering through into other European, other markets globally, and certainly here to Europe. The stocks Europe 600 up by 1.2%. The basic resources sector up by 3.25%, as we see some commodity prices being lifted by talk about what if we saw some loosening of Chinese COVID policy. BP is down by 0.3%. The company reporting near record profits, also doing a big buyback. But with some of that in the price then this morning. And Credit Suisse up by 1.9% as they continue to try to stage some kind of recovery from all the scandals of the past, the restructuring we saw announced last week, the sell-off in the share price in the immediate aftermath. And again, the shares trying to rebuild then, Kailey, some ground.
All right, Anna. Well, let's go now to the ADIPEC Energy Conference in Abu Dhabi. Manus Cranney is there now with Bob Dudley, the former CEO of BP, who is now the chair of the Oil and Gas Climate Initiative. Manus, over to you.
Kailey, thank you very much for that introduction. He doesn't really need an introduction. It is Bob Dudley. Bob, good to have you with us today. You have managed through many cycles, many presidents, many administrations. We've now got a new kite flying from the House of Biden, perhaps a windfall tax. Do you think it will take hold, or is it just a puff piece ahead of the midterms?
Well, I don't know. It's clearly a political rhetoric aiming at November 8th with the midterm elections. It's very harsh rhetoric for an oil and gas industry who's probably producing flat out both in oil fields and in refineries. Taking that money and that capital, I think the CEO of Exxon reminded that it goes back to American people in the form of dividends, which go into massive amounts of pension funds. But the rhetoric is quite divisive and unhelpful, I think.
And it does trickle down, it's trickle-down economics, one could say, into the dividend in your 401k. But big oil will use that narrative, oh, windfall tax, we won't invest, we'll delay our capex. How true is that? You've run BP, you've run TNK BP. How constrained can capex really be on the back of maybe a one-off or a twice-off windfall tax, really, Bob?
Well, it depends on what kind of a windfall profits tax. There was one in the United States in the early 80s that went on for years, and it did curtail investment. And you could see that again. I mean, companies have a capital budget based on their earnings and supply of cash flow. So, of course, they'll right-size the amount that goes into capital versus dividends versus big investments, in capital. So it will reduce it somewhat. And this is at a time when the oil and gas companies are really turning into energy companies. They're investing in renewables and all kinds of other things, which have a lower rate of return right now than oil and gas. So that's probably the one that might suffer, which seems counter to what we're trying to do in the energy transition.
Well, let's talk about that, because the Oil and Gas and Climate Initiative, which is your world, the debate is this. You have windfall tax delivered by the government, which may stymie capex. But the backwash of that is into your world, which is about those investments in the transition. Is that the tail risk of this windfall tax? Is that the risk that you worry about?
I think it's a reduced amount of investments in everything with the windfall. It doesn't matter, even oil and gas projects, but the renewable projects, the clean energy tech, everything will come down. And I don't know, it's not going to eliminate it, most certainly, but the percentage available will likely drop. These companies are really committed to the energy transitions. They see it as their future. They're investing in wind, solar, even some in nuclear.
We were walking out of the Managers yesterday and we were chatting about today, and you said, Manus, there's some really easy wins in your world of the transition. What is the easiest win that we should be talking a little bit more about?
Well, I think, to me, it's not only investing in renewables and the technologies that produce energy, but clearly one of the issues on emissions is methane or methane. And that, to me, is the low-hanging fruit. The technology is coming along with satellites, aircraft, drones, sensors on the ground. There's going to be nowhere to hide. And so the industry is coming together, sharing data, and we'll all be able to look at it like weather maps in the future here. So this is going to be the first big thing to do to reduce emissions.
Okay, well, let's keep an eye on that. I want to reflect back. You also hung your hat on TNK BP. That was the days where you got to know the Russians really well. Here we go towards December the 5th. The real risk is this. Russian oil flowing into Europe gets halted. Talk to me through the prism of the Russian psyche. I'm quoting my inner Tom Keane here. Talk to me through the psyche of the Russians. Will they just weaponize oil and not allow the Treasury to dictate the price of oil from America and these sanctions? How will it bite? How will the Russians react to the two issues?
So I was at TNK for about 6 years, and then I've been on the Russian national oil company Rosneft until the invasion happened.
Yes.
Stepped away from that. So I do feel like I know them. I know how they think. I think the West does not recognize that they really didn't want NATO on their borders. And so I think that's part of the psyche. One of the Russians said to me one time, how would you feel, Bob, if the Russian troops were on the Alberta border? So this is quite an emotional issue with it. I would never have expected this invasion. Few people I know that understand Russia would have expected it either. But now, I learned something a long time ago. If you poke a Russian in the chest, they will punch you in the face. And I think just this last week, the supposed drone attacks on the Black Sea Fleet in Crimea resulted in this really strong reaction here. And so I don't know where this is going. I hope rationally, there's a way out for everybody. I think there needs to be a face-saving way out for everybody here, or it could get worse.
Who knows where the de-escalation ramp is in this? We need to close off with China. Again, the other topic that we briefly touched on. How big a boost to price of oil do you think we can get if China incrementally opens and then reopens more fully in the back half of 2023?
Well, China's grown for 8 to 10% for 2 decades now. Yeah. Pandemic comes along, the world, everything, second largest economy in the world, shuts off. And then price of oil drops terribly down to negative. If you remember, there was a day there it was negative. And then coming out of the COVID, suddenly the engine of China came up again and the price of oil went up. I think that was the primary thing, as well as lack of investment in the industry due to ESG reasons and the pandemic just put a lot of pressure to not invest in oil and gas projects, has affected it. So today, China growth rates, which I thought might be 5 or 6% this year, looks like they could be under 3. That's a historically very low level. So we're all watching to see whether the COVID lockdowns come out of it, what Chairman Xi decides on the economy. They're going to need lots of oil and gas, but it may not be at the 8% growth rates we've seen before. And I think that's a huge variable in where the price of oil can go.
Okay, Bob, thank you very much. We're going to hand it back to London to your other favorite on Bloomberg, Anna Edwards. I think I'm handing back to Anna. How are you?
I'm fine, thanks, Manus. I'm sure we're all his favourites. Manus Crowley with Bob Dudley, former CEO of BP. Really fascinating conversation. He, of course, now chairs the Oil and Gas Climate Initiative. Really interesting to get his perspective, though, after years in the oil sector. More from Adipec Energy and the conference taking place there later today. Manus will be speaking to Amos Hochstein, who is US Special Presidential Coordinator for Global Infrastructure and Energy Security. That's at 6 a.m. in New York, 10 a.m. here in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, an interview with Uber CEO Dara Khosrowshahi. That's at 5 p.m. in New York, 9 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kailey Leinz and Kriti Gupta in New York. Matt Miller is off today. Let's talk about Twitter. Elon Musk's Twitter shakeup continues, with Musk expected to appoint new product leadership. This comes after Musk met with over the weekend with close friends and advisors on how best to change the service that he bought for $44 billion. Joining us now to discuss is Bloomberg's Alex Webb. And Alex, he's certainly wasted no time in changing the people at the top. What do we expect to see on that particular front?
Well, we don't quite know who he's going to appoint. He's brought in a few advisors, the likes of Jason Calacanis, the VC, as well as someone from Andreessen Horowitz, the big venture capital firm. There have been whispers that the former product head has been around the building, unsure if they're going to appoint him. The thing that our colleagues Kurt Wagner, Ed Ludlow and Sarah Fry are reporting is that product team heads have been told to identify 50% of their headcount to lose their jobs, which clearly that is unsettling if you are one of those people. It's not quite the 75% of the total the Washington Post had reported had been identified 2 weeks ago, but it's still a hefty number.
Alex, another change that he's potentially talking about is charging users for things like blue checks. So it's kind of a selfish question as someone with a blue check who doesn't necessarily want to pay $20 a month for it. Is that going to work? I understand trying to diversify your revenue sources from just solely advertising sales, but do we have an understanding of what the reception of those kind of ideas is like? Are people willing to pay to use Twitter?
I think there are two parts to this. There are the existing people who have a blue check, whether they be willing to continue to pay for it. I've seen estimates that there are in the order of 300,000 blue ticks out there. If you extrapolate and $20 a month, you're looking at maybe 6 million a month in additional revenue, maybe then 72 million a year. That's not going to move the needle. It's more about attracting other people and sort of encouraging others who don't currently have a blue tick to pay for the privilege, and that will be when it starts to become a little bit meaningful. I think, you know, for the likes of us, he probably would hope that Bloomberg, in our case, would pay for us to have a blue tick. It seems I don't know what Bloomberg would do, but I think a lot of other media companies might go, well, we'll pay for our official account at New York Times or at NY Times, for instance, to have that. We're not necessarily going to pay for the 2,000 people in the rest of the newsroom.
Alex, what kind of precedent is there here when it comes to the social media ahead of the midterm elections? I mean, we talked about how Elon Musk will, of course, come under some scrutiny, but I believe 2 years ago, Mark Zuckerberg came under quite a bit of scrutiny for Facebook and its role in the 2020 election. What kind of precedent are we looking at?
Well, we don't quite know what Twitter is doing with its, content moderation. There have been whispers that fewer people are being given access to those tools. You could view that actually as a positive because perhaps too many people had access. It's pretty close to the midterms, clearly, so it's hard to know whether at this stage any changes would be able to have any meaningful impact. It's more worrying if you look a little bit further forward to the presidential election. Facebook obviously has been in the crosshairs of this for some time. It obviously has far more users than Twitter does, in the order of 2 billion active users, whereas Twitter has about 10% of that. Facebook has been criticized for 6-8 years on this front, and in the 2020 cycle, there was still plenty that it could do. So, lots of people were inferring that if you're tamping back on some of those efforts, the results aren't likely to be positive.
Yeah, some interesting political scrutiny, no doubt, on many angles here. I saw that one Democrat was urging a security review because of Saudi Arabia's involvement as a backer of this Twitter deal that Elon Musk has put together, of course. Alex, thank you very much. Bloomberg's Alex Webb joining us with the latest on Twitter. Coming up on the programme, we'll get back to the broader markets. Ahead of the Fed, Diana Amoa joins us, Kirkoswald CIO for Long-Biased Strategies. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Kriti Gupta in New York and Anna Edwards in London. Matt Miller is off today. Now let's take a look at what is ahead today, and Matt is missing. The Bank of England will become the first major central bank to actively sell sovereign bonds held on its balance sheet. In Israel, voters are going to the polls for the 5th time since 2019. Expected U.S. economic data includes manufacturing PMI and job openings. And finally, earnings continue to roll out. Pfizer, Uber, and AMD are among the companies reporting results today, Anna.
Yeah, so we're still in earnings season as investors await more earnings, eco data and central bank decisions. Let's talk to our guest this hour, Diana Amoa, CIO for Long-Biased Strategies at Kirkoswald. Very nice to have you with us, Diana. So you're focused on long strategies, long dated strategies, but let's focus on the here and now around the Fed, and obviously that'll have implications. What kind of pivot or step down, or describe it however you like, are you expecting to see from the Fed? Because, and how likely are they to signal that, because there are financial conditions, risks attached?
So I think in terms of this current hiking cycle, this is probably the most important meeting for the Fed, because it's not just about them signaling where they want rates to be, it's also about them signaling the magnitude of hikes going forward. Markets are already pricing in a much slower rate of hikes from the next meeting onwards. And I think the Fed is really in a conundrum right now, because they've said they're data dependent, and they really will let the data dictate how far they go. So forget about whether it's 75 or 50 going forward. And so far what we're seeing from the data doesn't actually indicate that they need to be pivoting aggressively. And I think that's where the nuance in this conversation around whether the Fed is pivoting or just going back to 50 basis points, maybe possibly 25 basis points down the road becomes important. We've seen this narrative play out in other economies, particularly in emerging markets, which the US inflation right now is behaving like an emerging market economy from an inflation perspective. You pivot too soon, or if you step down too soon and second round effects are starting to de-anchor, then you run the risk of actually losing your credibility as a central bank.
Yeah, interesting comparison. Chrissy.
Yeah, Diana, I wanted to ask you specifically about the Fed's thinking here, because what seems to be baked into market consensus and arguably perhaps Fed thinking as well is that inflation has already peaked. But then if you start to factor in potentially a windfall tax here in the States or simply the grain agreement that Russia has decided not to abide by, still having a lot of those shipments, it's something that's boosting the commodity sector today in the trading day. How much of that is the market perhaps missing when it comes to what the Fed is going to do next?
I think the market right now is trading on a backdrop that we're not in anymore. They're trading on a backdrop where they expect the Fed to support financial conditions, but ultimately, and that's a strong point you're raising, a lot of the inflationary pressures we're seeing are also supply driven. And to the extent that food, energy prices are not in the Fed's hand to control, to the extent that some of these pressures are coming from geopolitical shocks that have nothing to do with monetary policy, it's going to be very hard for the Fed to step down credibly. And when you look at the data, core inflation is still rising. We haven't seen a peak to that. Unemployment rate is still at the lows, so we're not seeing any sort of easing in the labor market. And, to your point, food and energy prices are still an issue that the Fed has to contend with.
So, Diana, finally, as you are head of long-biased strategies, is there any long-duration asset you feel safe buying right now?
The question is, why would you buy long-duration assets when cash is actually yielding what it is right now? If I can get cash at 4% plus, do I want to take that extra risk of duration assets, especially when we're just starting to see quantitative tightening coming into play? We have the Bank of England today will start selling bonds. The Fed is still underway with its QT program, which doesn't really necessarily bode well for duration in the medium term. And so I'd say for me, cash is probably where I'd be more biased to position, if anything, not necessarily going for duration just yet.
Okay, and what would change that view then, Diana? What do we wait for cash to become less attractive?
We need to see the data turning. Everyone is trading recession, but we're only seeing a recession in parts of the world. In the curve that matters, in the US curve, the data still remains very strong. So you need to actually really be expecting to see a recession coming in or an anticipation that inflation has peaked. We're just not seeing that in the data.
Okay, so we don't see it in the data yet. Very good to talk to you. Thank you so much for making your way in to see us. Diana Amoa joining us there from Kirkoswald. And as Valerie was pointing out to us earlier, we are seeing further inversion, different parts of the curve now inverting, perhaps the parts of the curve that the Fed likes to talk about. We'll see whether that has any impact on Fed thinking. A really interesting conversation, though, setting us up for the Fed meeting, which kicks off today, concludes tomorrow. We get the results of it tomorrow, of course. That is it for Early Edition. Surveillance is ahead with Tom, John and Lisa. They will be hearing from Julian and Emmanuel of Evercore ISI, amongst many others. They'll keep the focus on the markets for you. This is Bloomberg.